Thank you all for coming out. I think you're going to enjoy this presentation today. But first of all, I want to talk to you about a little bit about what what the process is and what we normally do. You usually have a speaker for the first 30 to 45 minutes. Um, out if something comes up that's pressing that you need to discuss. But after that, hopefully you'll stay for that portion of it too as well, because that's the networking portion after the speaker is done. And what we're going to do is put people into breakout rooms, probably of about 3 to 4 people, and you'll get to introduce yourself and get to know more people who are in the commercial space today. With that, let me give you a little bit of background on Edmund, who's our speaker today. And read his bio to you. Edmund started his career in private equity real estate in 2002, climbing the ranks to become a senior partner, managing $500 million in investor equity. His personal book of business reached 70 million, with the top 1/3 comprised of high net worth family office clients. In addition to his achievements in private equity, Edmund was a licensed stockbroker at a top Canadian brokerage firm and a licensed insurance advisor for Canada's largest national insurance firm. His diverse licensing enabled him to excel as a well-rounded estate and tax planner, particularly for ultra-high net worth families. Edmund's clientele includes well-known Canadian families, a 25 million lottery winner, and an NCAA athlete. Although retired from the financial services industry, Edmund continues to make an impact as a capital raising coach for the financial professionals. His clientele extends to former US Pentagon staffers, US aircraft pilots, and senior commanders in the US military. That's just a little bit about Edmund. And with that, I'll turn it over to Edmund and he can go and talk to you a little bit about capital raising, and feel free to ask questions.
Sure. Thanks a lot, Charles. I guess for the person, you're on mute because I get a little distracted. So if you're not on mute, maybe just put yourself on mute. Yeah, great. Awesome. So yeah, thanks for that introduction, Charles. So I guess one of the first things that I'd like to do is sort of on the formal sort of aspect of private equity. And in private equity, there's really two sides to the house. There is the asset management side, and I kind of equate it's in the NFL, right? You gotta, when you get to the pro leagues and you start to become more and more professional, you really focus in on one side or the other. And the two sides are management, which is acquisition type of stuff. And then the other side is all the client facing side. So that would be stuff like capital raising and investor relations. Also, before I get too far, a little bit of housekeeping. I'm noticing I'm a little low on bandwidth. So let me know if I'm cutting out. Just put it in the chat if I'm cutting out for you guys, and then I can switch over. I might lose quality, but I'll be a little bit more consistent. So if you start to not catch what I'm saying, just let me know. And then I think also in the chat, there's a lot of things that I could talk about when it comes to the capital raising side. So in my 20 years in financial services, my focus has always been client facing, right? So it's all the capital raising and investor relations. But as a senior partner, I sat in the boardroom where I hear the operation side, but I don't know it from like an anecdotal point of view. When we look at capital raising, which is the other side, that is 100% my focus. So just I guess if you could give me a benefit in the chat, if there's a couple of things that how long you've been in real estate syndications, and maybe if we're talking about capital raising, what are some of the things that you'd like me to talk about tonight? Any kind of focus that you're having specific challenges? I would like to spend our time that's most beneficial for all of you, that you get the most out of it. So feel free to don't be shy, just put it in the chat and I'll take a look and see some of the things that we're talking about. There's a lot of stuff that I could talk about after I've been doing this for 20 years, but certainly if you have any kind of particular to bring them into the chat. So while we're waiting for that, I'd like to do is I'd also like to give you can see Amy Silva's here. She's going to be speaking next month. Two of us, we're both focusing in on capital raising, but different aspects of it. So what I would argue, what Amy is talking about is how to connect with people through social media and things like, and connect with what she says, connecting with strangers.
Oh, nice.
All right, Daniel, did you You have a question there? Sorry, Daniel. I think you got. Oh yeah, sorry. So what in the industry, what I consider what Amy's doing is a very important part of capital raising, which we call lead generation. So lead generation is also funnel filling. So at 5 people that for leads, then that's a very small sales pipeline. And a way to really ramp up your capital raising is to your lead generation, which is very important. And Amy is a specialist at showing you of how to increase and how to multiply that in a huge fold. But my focus is more of a specialty of taking those leads and bringing those leads from first contact to first check, right? So that entire sales process, and that's what I spend. Like I'm not that great at lead generation. In fact, I had a team of people that did lead gen. That's why I really like working with Amy, because Amy fills in a spot that I don't like doing or I'm not a specialist at. But when I get a big pile of leads, okay, well now what do you do with it? Okay, so I'm just taking a look at the chat here. How do you actually profit from capital raising? Okay, that's 7 years. Acquisitions. Okay, so when we're talking about capital raising, I think the first thing that I would say is to be a really good capital raiser is to be empathetic attitude. Okay, so empathy, not to be confused with sympathy. Empathy in capital raising or in sales is knowing what it feels like to be the other person, right? So I think that's understanding in the industry. What we call is starting to specialize in an avatar. And normally when I work with people, we do 2 avatars. Right? And the reason why we focus in on avatars is focus in on what we call like a sweet spot. So if you're looking at an avatar, we're essentially going to be, you have to qualify as a 506C. So in 506C, we're talking to accredited investors, meaning that they have to have at least $1 million of investable assets or $200,000 worth of W-2 for the last 2 years, or one of the two, right? With that, and that's the first part of capital from strangers. So the first piece is trying to understand what it feels like to be that individual. So if I could break down the market, I would say that we're taking a look at, we got somebody with a live mic here. So Ram or Lisa, sorry, somebody's got a hot mic there. So all right, so when we're talking about capital raising, one of the first things to do is we're talking about empathy, and then empathy of a person who has $1 million of investable assets. So let me break down the accredited space. So I would say of accredited investors. So the first one I would classify as like $1 million of investable assets, all the way to about 2 or 3 million. That's a certain type of investor profile. And once you start getting to 3 million to about 5 million, like, or the first million to 3, I call them newly accredited, or people that don't even know they're accredited. And then the next layer you get to is people that are about 3 million to about 5 million. That's a different skill set. RIAs or licensed advisors. They'll have licensed accountants and lawyers that are working with them, and you'll be interacting with some of them as well. And then once you start to get to like 5 million and above, like million to 7 million, maybe even 10, then you start getting into bigger and bigger challenges. So there's different niches when it comes to raising capital from strangers or talking to strangers from in this category. So first place to start, if you're relatively new to capital raising, the best place I argue to bypass friends and family, to bypass 506, focus solely on newly accrediteds. And the reason why I say this is because I've managed money for accredited investors specifically, but I've also had clients that were not accredited, like when I was doing insurance, for an example. And I would say that people that are not accredited, it's not a prerequisite for like the skills you learn is not a prerequisite for people to focus in on skill set. And the reason why is this: if, say, for an example, you're taking a $50,000 check from your $100,000 cousin, you are now managing 50% of your cousin's money. And your cousin is going to be, looking at that, and it's going to be on your case and always asking for updates in investor relations requirements post sale or post capital raise. And there's a story that I tell people. It's like I raised a $50,000 check from a client, and then a year later, I updated that client on how the investment was doing. This is for real estate syndication. And you know what the client said to me? He said, "What was your name again?" And I said, "How much do I have invested with this?" And I argue at that point, my fiduciary responsibility went to zero. I didn't even remember who I was. And so I brought this to my boss, and my boss said, "Well, that guy's not really a client. He's just a lead. He was like a $10 million guy that gave me $50,000 just to get me out of his office." Much easier to manage than 50,000 from your $100,000 cousin. That's the difference. And if you were to take the same amount of time and invest it in investor relations with those existing clients, you'd do much better. Because here's one of the big secrets when it comes to after the first interaction. The majority of capital that our firm raised when I was a senior partner of a private equity firm, the majority of capital that we raised was through investor relations, not from first checks. And it's very similar to oil and gas. So it's kind of like when you go and you're drilling for oil in Texas and you find an oil well and 1 barrel of oil comes out of the ground, you don't cap it. Right? It's like, oh, we got 1 barrel of oil. Here we go. What you do is the first thing is when you strike oil is to figure out how big that oil deposit is, because the first barrel that comes out is the most expensive barrel, and then every subsequent barrel is cheaper and cheaper. So this is what I explain to people, that when it comes to capital raising, it's mostly done through investor relations. So it's done through something called mind the diamonds in your backyard, right? So that's a very important piece. So that's one thing to keep in mind, that once you understand this, the big see when it comes to capital raising is not a transactional based model, right? So the two is difference between a relational based model and transactional model. And that's two ways that you can sell. So transactional based selling is something like if you were to go and sell a product where after the person buys it, you would never see it again, right? Then transactional based selling can work. When it's to capital raising for real estate syndications, though, it's different. We're talking about relational based selling, and relational based selling is something that you're maintaining a relationship with a client for a long period of time, and that's dovetailing into the investor relations component of things. You're trying to build a relationship, it changes what you're actually selling, and this is one of the first mistakes that I see people make when they get into real estate syndications. The first mistake that I see is that people will get in and they'll go to a learning program of some kind. I went to one as well, and get super excited about all the nuances of real estate syndications. And there's a lot of technical data. Super excited about it, and and then you're going to go and find somebody who's just slightly curious, and you're just going to data dump, and you just throw in all the stuff that and people can get overwhelmed. Right? So there's a really good line when it comes to capital raising. Right? The line is this: is logic, think, emotion will get people to act. Logic will get people to think, emotion will get people to act. Now, when we're talking about very technical sort of product, you have to talk about the technical components of things, and the logic, you have to balance it out of how is it going to affect somebody, or how is that going to benefit somebody. In the sales parlance, we call this features versus benefits. That's another thing to write down. Features versus benefits. So if you're a very technical based person, and I've trained and I coach some IT professionals or engineers, they default to very, very technical, right? They're very, very strong suited there. And that's a place that they really love to articulate themselves from, right? So, sorry, I'm just reading some of the notes here. No, there's no slides, right? That's one of the things. It's really just to keep you feel free to take some notes. I apologize. I just do that so I can be very free and talk about things that are interesting to people. So somebody's just giving me a direct message here. Yeah, I'm very freestyle. Thanks. I'm looking to set up a new evergreen fund. Okay, so for somebody has a question here about setting up things legally. So I do have to caveat my discussion tonight. I am not a compliance person, nor am I a lawyer. So I'm not the person to talk about how to set up legal entities. Unfortunately, you're going to have to find an SEC lawyer to make sure you're doing it compliantly. What I'm doing is, okay, so Vince says I'm cutting out here. Sorry, my apologies. Okay, let me switch over to another. Let me know if this works better. Okay, I'm going to switch over here. So my internet's probably going to be a little foggy. All right. So we're talking about empathy. We're talking about things like dealing with newly accredited, empathizing with people, and then emotion is. So the difference between features versus benefits is features. If you would imagine, take a look at a computer box. All right. So if you're going to take a look at a computer, on the side of a computer box, you're going to see a whole bunch of bullet points. Those are all what we call features. All right. It's going to have a certain CPU. It's going to have a certain whatever, all technical details. And that doesn't necessarily mean one thing or another until you actually translate of how that's going to improve your life. That's where the salesperson comes in, or that's where the capital raiser comes in. Jennifer, you just got a hot mic there, I think. Jennifer Williams. Sorry to call you out there.
Do this. There's got to be a number of whether it was really necessary.
Oh, I mean, maybe you, Jennifer. Sorry. So one of the things that you're doing is, in order to sell, you've got to. I think that if you want to go and collect a check, the first thing you've got to do is be able to increase the value, which is relational based. It's all emotion based. But if you can increase the value of what this is going to provide, or what real estate syndication is going to provide for your prospect, then you can have a sale. But if you get pushback or objections, then that means that you haven't tipped the scales enough, right? So you haven't shown enough value where it increases beyond your ask. So if you're asking for a $50,000 check or a $100,000 check, you've got to show that person the value to them that is above and beyond the $50,000 or $100,000 that you're asking for. If you don't do that, the answer is going to be no, because I don't see it. So how do you do that? It's all these pieces that work together, which is, well, first off, you have to know that person. That goes into the empathy. What does it feel like to be that person? What is that person looking for? What do they hope for? When they come and they're talking to you, or they're looking at real estate syndications, what do they hope that can provide? So it would be many things for different people. So for an example, somebody who is looking to get out of a terrible W-2, they make a lot of money, but they just hate their W-2. It's a grind. It takes them away from their family. So if you knew this, then you can say that, well, real estate syndications is different from your 401k or investing in stocks and bonds, because they don't send you cash flow. It doesn't send you money. It doesn't send you income, or it doesn't send you, monthly cash to replace your W-2. It just gets bigger and smaller. So if you understood this, then you can say something like, what you're really looking at is, this is not a real estate investment. It is and it isn't. Really, what you're looking at is more time with your family. That's essentially what this investment is. That's an example of a benefit versus a feature. A feature is a real estate syndication of 120 units somewhere in Texas, and it produces 7% cash flow. Those are all features. It's emotionless. But if I start saying that 7% means more time with your family, that 7% means more time with your spouse, those are all emotion-based statements that also start to develop a relationship. Because here's the interesting thing. The better you get it, and if I could leave you with one thing, one element of tonight, so that if you want to be a really good capital raiser, is to gain the skill of empathy. Because if you can gain the skill of empathy, and you can understand what it feels like to be other people, and then be able to articulate that and let them know and verify and validate all those things that you heard. Empathy in North American society, exercised correctly, is interpreted as kindness, right? So I'll say that again. Empathy in today's world, that is exercised correctly, is interpreted as kindness. And here's some of the reasons why I think this happens, is because we're just so strapped. We're always pushing for more, and we're always pushing to make more money, and we have less and less time. And when we're under such pressures, people start to focus in within themselves. It's a social sort of dynamic that you see. Essentially, what I've become is at the very high level of capital raising, you become a social scientist or a student of social science. And one of the things that we see is that the tighter our timelines are, and this goes for everybody, including especially for the accredited sort of investor or the accredited person, they're probably pulled in many different directions and have very, very little time. And because of that, everybody focuses in on all the stuff that they have, and we're starting to lose empathy in society. And if you can start to exercise empathy well, you start to stand out, because there's so few people that come in and ask you, hey, what are you dealing with today? What are your biggest challenges? How could I help you today? Most people are going to step over themselves saying, hey, I need to get there. I need to get here. I'm 5 minutes late for every meeting. I need this. I need this. I need that from people. And people seem to be struggling and strapped and trying to go through life on their own. If you can come in and start to survey and talk to people and genuinely care about what they're dealing with, you'll start to make a lot of emotional deposits, and you'll start to learn, become very, very empathetic. And when you put these emotional deposits in somebody's life, that's how you start to make a relationship, is because you started to care about that other person. And in reflection, you're exercising kindness. And then that person recognizes this person's a really kind person. I'm starting to view and I'm starting to recognize that this person, my life is going to be better if this person's in it versus this person's not. Because here's the biggest key when it comes to relational versus transactional selling. When you're transactional selling, the focus completely is on the product. The focus is on logic. It's on what this product does. It's all focused in on the real estate syndication. And you only intend to sell them that and get that first $50,000 check, and then you're gone, and then you're off trying to find somebody else, because all you've done is just drilled and got one barrel of oil out of the ground, you capped it, and now you're looking for another one. Very expensive way to do it. Instead, if you are going to go a relational, sorry, I think we got another hot mic there. All right, thanks. If you go to relational ends up being is that it's a very, you're tapping into the very deep wells. But once you recognize, I have my mentor who said this. He said that, Ed, we're licensed stockbrokers, we do real estate syndications, but you've got to recognize, like, since 2002, I've been saying, 7% cash flow with an 18 to 20% IRR, right? Real estate syndications have been that for the last 20 years. And they all pretty much look the same. You're anywhere from 80 to 120 units. We were specialists in DFW, so Dallas, Fort Worth, but they're all over across America. They all look, you take a look at the comps of Marcus and Millichap, CBRE, they all look the same, right? Very, very similar. So that once you understand that, you recognize that your investor or your prospect can invest in pretty much any one of these deals across America from anybody. Stockbrokers are even worse. There's only so many stocks on the Dow Jones, right? And your client can probably buy that stock from anybody across America. Tons of people that are RIAs that they can buy. So once you recognize that, you have to recognize you are not selling a real estate syndication. You're not selling a stock or a bond if you're a licensed person, for me. But what you really understand is what you're selling. The only thing that you have a monopoly on, the only thing that you can sell that nobody else can sell, is you. And when you go to a relational based model, the main thing you're selling is you. And when I say you, what you're saying is that things like your insight, your perspective, your reason why you're endorsing a specific deal, why these real estate deals are important, because you've curated a specific group of real estate. You've made a choice of why you're presenting those real estate deals. And if you can show the value, and the biggest value is because I understand who you are. I understand what you like. I understand, what you're looking for. I understand that you want to retire. I understand that you want to fund your kids' college education, or whatever it is. Is that if I feel that you know me and you care about me, then it starts to put a bigger weight on the recommendations that you're making. And that's a big part of that. In the license industry, we call this, and you don't, people that are just in real estate syndications, you don't have to abide by this. But in the real estate, in the license world, we have something called know your client. It is an actual requirement to know what your client is. It's forced empathy. And that's how I learned it. And it's the better you know those clients, the better you can make investment recommendations. In this case, in the real estate syndication world, in the exempt world, you don't have to abide by those rules, but it is an industry best practice to get into. That if you can start to really care about people and really get to know people, that's how you go from the $1 million client to the $5 million client to the $10 million, all the way up to family office. Because I promise you, in family office, the transactional based model does not work. It is all based on relationship. And I've gotten to the point where I got to about third generation wealth, where I was managing somebody's money where their grandfather was one of my clients. And he's the one, when I was in my 20s, he's the one who entrusted me. Can you imagine when I talked to this person, hey, like, 15 years ago, this is what your grandfather taught me when it comes to real estate. This is how we cared about money management. These are his values. And that's a long-term relationship. And if you can do that, those types of clients are the ones that you can raise the most from. So here's another piece that I want to get into, and some of the early basics of raising capital. When you're talking to somebody in a real estate syndication, before you can collect a check for a real estate syndication, you need to make 3 sells, or that prospect needs to agree to 3 sells. So the 3 sells are, the first sell is why real estate versus stocks and bonds, 401k, SD, IRA, all the traditional investing that you would see. So the first sell is why real estate. The second sell is why syndications versus direct ownership of real estate. So single family homes, fix and flips, all this type of stuff. So once you convince somebody real estate is the greatest thing since sliced bread, now you got to convince them, but don't buy the house down the street and then fix and flip it, right? Now you've got to make a sell on why real estate syndication. So once they've agreed to real estate syndications, the last sell you've got to make is why you, or why the one that you're recommending, and why through you, right? So those are the 3 very specific sort of sells. So when you're talking to a brand new prospect, one of the things that I do is, not only am I talking to try to verify that they're accredited, the second thing I do is I'm trying to verify where they are in those 3 sells. Because if you go too far in the 3 sells, like if they don't know the first thing about real estate investing, and you start telling them about a specific real estate deal in South Carolina, it'll go way over their head, right? So you'll confuse a client. But if you don't go far enough, and say that you're at a real estate conference and somebody says, hey, I had 1031 exchange, I need a $10 million to place in 90 days. And then you start explaining why real estate is a great investment, you're going to annoy somebody, because you already know that they're bought in. All they want to know is, if somebody says, hey, I got a 1031 exchange, the first thing I start going into is why you want to do it through me. What is unique about me, and what is unique about the deals that I can show you? I immediately go to the third sell. But if somebody says, hey, we heard about this thing about real estate investing, and is that just like buying a second house? As soon as I recognize that, I know I have to go a lot earlier. So that's part of empathy. It's not only understanding the values and what your prospect cares about, it's also knowing where they are in that sales process. So here's the pros and cons of the two. That of course, the easiest sell you're going to find, or the shortest timeline you're going to find, is somebody who's gone through all 3 of them, or all the first 2, and they just want to hear your deal and they want to know why through you. So that's going to be the easiest sell for you. That's going to be the closest. You go to a real estate conference, everybody's bought in, and you just have to show your deal, and then hopefully they really like your deal, or they really like you, or both. And the only problem with that, the downside to that, is that it's a very tight market. It's a limited market of people that you can talk to that have already brought themselves to those 3 sells. If you go further upstream and you go to people that have never invested or never even considered investing in real estate, there's certainly a lot more people. The downside is that you have to do a lot more selling. You have to take them through all 3 gates, or all 3 sells. So there's more people to talk to, but it's going to increase your sales pipeline, versus fewer people, but it's going to be a shorter pipeline. So a lot of the times, what I recommend for newer advisors or newer syndicators is do a mix of both. Right. So have one avatar that is just came out of a real estate conference. They're totally bought in. They're just looking for a deal kind of profile or avatar. And then another one, which is people that I'm surrounded by that are newly accredited, that didn't even realize that real estate could be a really great avenue for them. So one of the things that I do is that's what I do. So I am a capital raising coach that talks about all these different nuances and how to go into specific sales for those 3 kind of different sales, because they're very different scripts that you would use for all 3. So we're kind of at a half hour here. Hopefully I haven't been cutting out too much and you kind of grasped a little bit of what I was talking about. I'd really like to, let me just read some of the chat here. So this is so spot on. Thank you very much, Bridget. Appreciate it. How long does it take to nurture these relations to the extent that they invest with you? How long do you know you've done enough that is what's considered a solid business relate? Lastly, 2 months on. Okay, these are all great. So Mel, you got some great questions here. So how long does it take to nurture the relationships to the extent that they'll invest with you? This takes, and this is all soft skills, and it takes time to understand when somebody is ready to invest with you. And there is no set timeline. I know that you would love to see this formula, like, oh, it should only take 3 weeks, or it should only take 4. This is the equivalent of asking, when I go out looking for a spouse, how long do I need to date before I can find somebody to marry me, right? It can take 3 weeks. It can take years. It all depends on the relationship between you, because we're talking about, that's the example. That's why I say this is a relationship. So it can be very fast, but it can also be very long. And it all depends on what you say and what mood that other person is in, right? So it's all over the map. I've had one client, I think one of my longest clients, I was chasing them for 3 years. So I would call them, like, I don't know, every quarter or every time I had a deal. And then I would go and visit them like once a year. And it took them 3 years before they wrote me a check. But I've had other people that's like, hey, like, we're looking for a real estate deal to invest. Can you come in? Like, the first $1 million check that I got was from a client that lived up north. It was like almost cottage country. It took me 2 hours to drive there. I drove there, met them for the first time. So I've been talking to them maybe 3 weeks on the phone. I met them the first time. And they said that if there was any person from downtown Toronto that came up to this cottage country, drove 2 hours to come see us, everybody keeps prospecting us from Toronto, all these different brokers or whatever, but nobody wants to drive up here. And we said, my wife and I said, the first guy that shows up gets our money. And that was the first $1 million account that I closed. I got it because I was the first guy that showed up that drove 2.5 hours. And that only took me 3 weeks, right? But they're going to be a big extreme, like one side or the other. I think that it really depends on how quickly can you build rapport. And that's where it comes to soft skills. How quickly can you empathize with that other person? How quickly can you understand what they're dealing with? And if you're really good at that, that sales process can be very short, right? It can be a couple of weeks. But there's people that are very timid and can take a little longer. How do you know that you've done enough? I think you know that you've done enough. And this really comes into some of the coaching that I like talking. It's coming up with the intuition to recognize when to go into what we call the closing phase. So the closing phase, and this is very, very, very kind of granular and detailed, but to specifically answer this question is when you're talking to somebody and you're presenting a deal, you'll start to hear what we call closing questions. Closing questions are, if I gave you a check today, how quickly would I get the first check? Right? That's a closing question. Or does this have to be a certified check, or can it just be a check like out of my bank account? Or do I have to liquidate funds from my SD IRA? These are all closing questions, right? So if you're talking about a deal, and once you get to the closing phase, you have to enter into the closing phase. Don't talk yourself out of the sale. Once you're in a closing phase, that's when you got to go, and the door closes. You got to keep going through and go to the end. But it takes time to recognize when that person's ready to invest. And it all comes into the questions and the objections that they're talking about. All right. Hopefully that answers that question. When dealing with new investors, do you just have to freestyle conversation like this one, or do you actually do a sort of presentation with slides or some other content? Great question. So very similar. This is one of the reasons why I like to quote unquote freestyle, is because this is my sales process. I do the exact same thing. I cater it to the individual. I would say that for me, the best sales process is one that is tailored to the audience, or tailored specifically to your prospect. That's the best you can do. But I recognize that not everybody is experienced in sales. It takes you like 10 years, 20 years to get to that level. So until you get to that, the second best thing to do is come up with a presentation front to back, right? So that you don't miss any key points. But as you start to, that's how I started. And as I started to get more and more comfortable with that material, then I could do it frontwards and backwards, and I can ad lib, and I can emphasize certain points, and I can change it. When I do, that makes it more customizable to the individual, because you can pick up certain nuances or certain responses in body language of your prospect. Charles Jones, sorry, I think you got a hot mic there. Charles Jones.
Coordinator Vic Fangio on the left of the.
Thanks. Yeah. So, and I think that's so. I think it really depends on what skill level you're at. If you're at the skill level where you could freestyle it and you can pick up and you can just kind of answer questions on the fly, 100% that's better. But until you get there, Try to write a script. And what you don't want to do is you don't want to read your script because people can recognize that, but learn your script and say it in such a way where it just seems natural, right? So Vince, hopefully that that answers that question. So we're kind of like 37 minutes here. We're going to go to 45. So if there's more questions, please feel free to go. I don't want to just be a blobbing head all the time. But if you have any other questions based on some of the things that I mentioned, or there's something that you want me to clarify, please feel free to ask in the chat or unmic yourself. Anything else?
Oh, Ed, I have a question. Okay. Andrew Seeker here.
Sure.
Yeah, so I went to a couple of syndication events. One was live, the other one was on the internet. And, you know, of course, there's these capital schools, capital raising syndicators and gurus that are encouraging you to network with other people that are attending the same course or school, whatever you want to call it. And so I went to one live down in San Diego earlier this year, and all the other investors, they were just interested in raising money for their project. So I don't know.
Why can't you watch?
Am I doing this wrong? I mean, or what am I missing here?
A little bit again.
Yeah, sorry, Mark here. Yeah, sorry. Can you ask that question again, Andrew? You're saying
Okay,
something.
yeah,
Are you doing it wrong?
Yeah. So yeah, earlier this year I attended a couple of syndication events, and one of them was live in person, and I met like 30 investors that were part of this course, this 2-day program. But when I talked to them about raising money for my projects, they were like, "Oh no, I'm just here to raise money for my projects." So I'm not sure, you know, it's like, why am I missing something here, or why should I go and attend these courses or join these groups if nobody's interested in helping me with my project? Then of course I don't want to be selfish, but I mean, obviously we join these groups and to raise money for our projects, right? So I think there's a conflict of interest here, and I was just wondering if you might have a different approach, or am I missing something here when it comes to networking?
Yeah, you've got a very good point, and I agree with what Amy's saying in the chat. Is that I think the real estate conferences are very good for professional or personal education and growth, right? To learn what's out there, learn what other people are doing. Very, very valuable. They may not be the best place to raise capital in, and that's what we talk about. Like, one of the things you want to do is create a sales plan. So your sales plan is going to go into, where is there a place where there's very little competition, where there's a lot of my avatar, where there's a lot of $1 million people in the room, where I'm the only real estate syndicator, right? Is there a place around you that can do it? So here's the interesting thing. America has the highest concentration of millionaires in the world. And if you're in one of the bigger pockets of like California, Texas, Florida, or New York, you're probably in one of the states with the highest concentration in the United States. But even outside of those 4 states, you still have across the continental, 50 states, the highest concentration of millionaires in the world. There's people internationally that say, hey, like, I'm a Canadian, right? So I'm born and raised in Toronto, but I would say, like, hey, if I was an American, you'd probably go outside, throw a rock, and hit three millionaires. And it's probably true. It's just a matter of, can you figure out where they are? Where do they hang out? And where's there a high concentration of them where you're one of the few, if not the only real estate syndicator that it's basic sales, right? So you don't want to go in a crowded market where everybody is there. Like, if everybody, you can't sell a can of Coke at a Pepsi conference, right? Don't go to a Pepsi conference, try to sell your can of Coke.
Yeah, you're spot on there, Ed. Thanks. Yeah, so I'm glad. Yeah, thanks, Amy, too, for the remark there in the comments there, because I was thinking it would be good to just go to these events and network, but yeah, I just ran into a brick wall. Nobody's looking at my projects, and I'm like, well, so yeah, okay. So anyway, for those of you out there, don't join Capital School or any of these other gurus that are teaching this stuff. I think it's probably better just to find an SEC attorney and just go direct to them, and then do do
Yeah, I
your
think
marketing.
it really depends on
Right.
what you want to look to do. So if you
Yeah.
want to look to learn and understand what's going on, that's fine.
Oh,
If you're
right,
trying
right,
to go
right.
to
I
Yeah,
understand.
if you're trying to go to a real estate conference to raise capital, probably not the best place to do it.
Right,
There could
exactly.
be other
Yeah.
places that are better, right?
Okay.
I
Yeah.
think Trevor had a
Thank you.
question as well. Yeah, you're welcome, Andrew. I'm glad that we can answer that. What would be some suggestions to show how real estate can be a good investment investment vehicle for somebody that's really comfortable with their do-it-yourself ETFs? Okay, so this is this is going to get very detailed level, and I can talk about this because once again, I'm a former licensed stockbroker. I don't do it anymore. I don't manage money. I'm not making any kind of recommendations. But you also have to be very careful about making a recommendation, comparing it to an ETF, because you have to be licensed. And so you have to be licensed in both things that you're recommending. So if you're doing a real estate syndication and you're doing it in an exempt market, you can talk about that. That's fine. But you cannot make a comparison to their Facebook stock or their ETF stock because you're not licensed to make that comparison, because you're not licensed to talk about that ETF. So you have to kind of be careful of that. Once again, I'm not a real estate lawyer. I'm not compliance. I just have gone through a lot of compliance, and I know that's one of the rules. So you just have to be very careful, seek your own legal counsel, and seek your own kind of compliance. But if you're doing that, basically what you want to talk about is, here's one of the biggest things. Okay, so when you get into accredited investors, no matter the net worth of people, they're always looking one rung above the ladder to the next group of what they're doing. All right. So the $3 million people want to know what the $5 million people are doing. The $5 million people want to know that, so on and so forth. The $10 million people want to know what the family offices are doing. But here's the thing about family office. There's a bigger fish than family office. So family offices, when we're managing family office, who do we look to? We look to institutional investors, AKA pension plans. So pension plans are some of the largest institutional investors in America. CalPERS is an example of one of the largest pension systems. And then so is the public employees of New York City, right? Some of the largest pension plans. So what do family offices do? Family offices watch those pension plans, and those pension plans, here's an interesting tip for all of you. Every single one of those large pension plans, they have to come up with their asset allocation, and they have to make it public. Asset allocation, probably don't have enough time to talk about it tonight, but asset allocation is probably one of the biggest things when it comes to money management. So as great as real estate or as great as an ETF is, I don't think it should be everything. So it's not 100% of somebody's portfolio. If it is, you're playing weak-handed. It's kind of like saying that, hey, we are taking a look at the NFL, and man, quarterbacks are probably the most important player on an NFL team. If that's true, then how come that coach is not going to field everybody on the field as a quarterback? And I was like, hey, let's do that. It's like, hey, you know what? I'm going to put a quarterback at every single position. I'm going to fill it with a quarterback. It's like that coach would be fired. A really good team has a diversity of different people, right? A special teams, offense, defense, linebackers. So all of them play a specific role. It's exactly the same when it comes to money management. As great as I think real estate is, or real estate syndication, I don't think it should be 100% of somebody's portfolio, just like I don't think an entire NFL team should be just quarterbacks. And at the same time, ETF and do-it-yourself or ETFs, same thing. When somebody says they're very comfortable with their do-it-yourself ETF, it sounds to me like they have a team with just linebackers, and that's it. You're never going to win a Super Bowl if all you have is a team full of linebackers. You're missing out a whole bunch of key elements. You don't have special teams. You don't have all these other pieces. That's what you're looking to do, is you're trying to educate people is that real estate. And here's the answer for most people, in case if you go and look up the asset allocation for most public pension plans like CalPERS and New York City public employees, the answer is about 30%. 30% in private equity and real estate syndicate, I think it's private equity and real assets. And that's what CalPERS does, right? So they'll have a bit of a range, but if you add up those 2 points, they get up to about 30%. And same thing with the New York City public employees. Same thing. They're just upped their asset allocation, I think, from 25 to 30% in private equity. So for me, it's the same thing. So I would, as a fully licensed guy that does the entire wealth management, I would reserve about 30% for alternative assets, and then the other parts would be mixed in for other parts, the other components. But at the same time, I don't want to get into that detail because I'm not licensed to talk about it to you guys right now. But that's understanding that piece and say, just stick to the 30%. And if you don't think that 30% should be some of your portfolio, well, talk to CalPERS, talk to the New York City public employees. They think that, public employees or their pensioners should have about 30% into alternative assets.
I mean, really appreciate your time and all that you've done for us. We're running it close to enough time that we need to go into the networking groups. But the first thing I want to do is take a picture of everyone who's here. So if you could just unstop your video and bring yourself up so you can see your picture. And I'll take a picture real quick, and then we'll go into the meeting groups. One, two, three. Yep. Okay, well, so let me stop the recording.